I'll tell you where the high yield's going down and where it's very dangerous, even if the equity is good. Can I tell you, this is my opinion, that what's going to happen is, as interest rates go up, there are a lot of people out there that own this trillions of dollars that don't understand. So these people go to cocktail parties, this and that, Mrs. Jones, and they go, wow, you're stupid. You got making 1%, 2%. I'm making 5.5%. And my wealth manager is so smart that not only making 5.5%, but do you know my HY thing, one of your ETF things with the stock, because they didn't even understand that they even own this high yield stuff. Oh, wow. Not only is that high HY going, but it's gone up for me. And I just made 10% on it. So now they're making extra on this high yield. Now suddenly interest rates go up. Forget even the market. High yields, the interest rates are starting to go up. Market could go up on that. We don't know. And then they go to the cocktail party, and the wealth manager says, rightly so, you just made all this money. You just up 10, 12%. Sell the high yield. Sell it. Because Janet Yellen's telling you it's going to go down because she's telling you she's raising interest rates. Let's sell it and let's go and buy treasuries or go buy stocks. So it could be the opposite. Stocks go up, high yield gets killed. But when that gets killed and when it is a run, there is nobody to buy that stuff. There is no one out there to buy that $1 trillion. And I don't know what ramification that can have, but it sure killed the market in 2008 when the housing blew up. And I am saying, that's, in my mind,
It's so different, Carl. The housing market was based on leverage. There is no, you don't have
leverage. Who's going to buy the high yields? I mean,
it's just not high yield. So first of all, I just 100% disagree with that characterization. First of all, higher interest rates, which I don't think we're going to see that much higher. Higher interest rates are actually going to move more money into the bond market, not less. Okay, most insurance companies their duration of their liabilities are longer than their assets. You have pension funds. You also have a transformation that's going on in the defined contribution markets, where we're using more target date type of funds for defined contribution. As we're all in this room getting older, and as you get older, you have a higher concentration in fixed income. So the reality is, demographically, there's going to be a greater need for high yield, for fixed income. Secondarily, as interest rates move higher, more and more pension funds are going to immunize or defease. They're going to lock in the higher rates, and there's going to be great demand for long stuff because they don't want the volatility in their defined benefit plan. They're going to just say, I'm going to defease it. When we've seen that in a large way in the UK, where most companies have defeased their pension liabilities. So the reality is, if we have higher rates, there's going to actually be more demand. I am not suggesting retail, who owns maybe a high yield product or something, should they sell if they have a high concentration? That may happen. We don't see rates moving up that much. We believe the Federal Reserve will begin raising rates in September. It'll be modest. We can't raise rates that much because we still have another year of the ECB aggressively buying. We can't afford as a country having the dollar much more appreciated, or our competitiveness is only going to deteriorate more, which puts a clamp on rates. I am not here to suggest, are some credit markets overpriced? Sure, but I don't see, you're going to have idiosyncratic failures like you always have, but you can't relate 07 to now, because 07 was predicated on dramatic amounts of leverage. Leverage at the consumer level, we all know about the leverage within the banking system, leverage in single-purpose corporations. You don't have that. Actually, there's less private capital leverage today than there wasn't than we've seen in tens of years. So you don't have that fundamental. That is not to say that you're not going to have failures at specific companies and high yield's going to be impaired. But the characterization that everybody's going to be running out of fixed income, I'll take that bet any time. That's something I know.
I want to answer that a little bit. I have to answer what he said because I disagree. But let me just say one thing. I'm a very simple guy. I really am. I look at things simply. I reduce it to a simple question. Let me ask you, why should anybody? So in the next year, you will admit, there's going to be defaults with the oil companies, high yield. There are a lot of high yield oil companies in your index. and there's going to be a bunch of defaults. So that's going to start coming. Now, you have to admit that when that starts coming, you look at corporate A, you look at A-rated corporates, and the A-rated corporates today, and it's even narrower with many of those high yield, you're getting maybe 2% less. So let's say yields go up a little bit. So you're getting 2% less. So why should any human being with any sense at all to get the extra 2% in a high yield, buy a high yield when they could buy a corporate A and not take the risk of losing 40% of their money? Why should anybody own those? That's all I'm saying.
I don't tell anybody what to own.
No,
and more importantly,
you just said they're okay. I mean,
no, they're not. But no, I'm not trying to.
Okay, good.
No, but importantly, most high yields owned by institutions, not by mom and pop. They're matching liabilities. They may have an impairment. I'm not suggesting that, and you may be right. You'll have that, but it's not 07 by any way of the imagination.
Listen, I can't predict. You got an 08 again. I am saying that we're riding for a fall of this, and I don't know where it ends. But there is definitely a great risk out there in what this high yield is doing, because it's so big. I mean, you got to admit it's big.
If you believe it's so big,
it's $1.5 trillion bucks out there.
The whole market,
the whole high yield.
Yeah, but then you have to
big.
be bearish on equities because it's going to have a follow-up effect on equities.
I mean, you didn't sell.
I probably will.
I don't agree with it.
You didn't sell Netflix because you thought the stock market was going to continue to go up, and up.
Oh, that was a valuation.
Yeah, that was really valuation. I mean, I didn't sell it because I was bearish or bullish on the market, even though I am. Larry is right. If what I'm saying is going to happen, the market will fall. But I am not telling you that's next month, maybe not even next year. I mean, they will go together, in my opinion. But I can't tell you here, hey, you know what? I'm really saying I'm bearish on the market, but I am very bearish on the high yield. That's all I'm saying.